Navigating payroll financing for temp staffing companies, smart solutions. Tired of chasing payments in a wild goose chase? Say hello to the solution. Payroll financing for temp staffing companies. Imagine having your own financial GPS guiding you through the cash flow maze. Get ready to untangle the knots. And guess what? The compass to consistent paydays is right here. Let's navigate together. Key takeaways on payroll financing for staffing firms. Cash flow fluctuates wildly in staffing, creating payroll financing gaps. Invoice factoring, purchase order financing and payroll funding can provide needed capital. Tailor solutions to your specific business needs and capacity. Strengthen internal processes and reporting to qualify for top programs. Specialized payroll funding platforms understand the staffing industry. The payroll financing challenge for staffing firms. Staffing agencies face unique payroll challenges that set them apart from other industries. Understanding these key pain points is the first step in identifying the right financing strategies. The feast or famine cash flow cycle. The staffing business is prone to dramatic swings in cash flow. Revenue surges when you land a big new client contract and ramp up placement quickly. But it plummets just as fast if that client closes locations or cancels the contract. Timing between payroll and client payments. Staffing companies have little lag time between when they must pay employees and when they receive payments from clients. However, client payments rarely align perfectly with your payroll schedule. You may pay staff weekly but only invoice clients monthly. Even with net 30 terms, client payments still take time to arrive. This timing mismatch leads to frequent cash shortfalls. Financing helps bridge the gap. High payroll costs. Between actual wages and added payroll taxes, staffing payrolls are large. And with temporary employees, you have constant churn and recruitment costs. For a medium agency with 300 billable employees, weekly payroll could easily exceed $150,000. Additional costs for taxes, insurance, retirement plans, etc. Those big outlays put extra strain on cash reserves between client payments. Alternative financing options for staffing agency payrolls. Traditional bank loans don't work well for the unique needs of staffing firms. You require flexible solutions that align with your industry's unpredictable cycles. Factoring. With invoice factoring, you sell outstanding invoices to a commercial finance company in exchange for upfront cash. This immediately converts receivables into spendable payroll funding. Pros. Receive 70–90% of invoice value within 24 hours. Ongoing factoring smooths cash flow gaps. Grow limits as your sales grow. Cons. More expensive than loans with rates from 1–5%. Require consistent sales volume to keep invoices flowing. Purchase order financing. Purchase order financing provides capital based on expected future invoices tied to verified client purchase orders. It allows staffing agencies to access funding needed to scale up staff and begin work on new temporary assignments and projects. As the staffing company completes the services outlined in the purchase orders, they submit invoices for payment based on hours worked, contractor costs, and negotiated margins. The purchase order lender then advances payroll funds to the staffing agency, allowing them to meet payroll obligations during ramp-up periods before collection of final invoice payments. Purchase order financing aligns payroll funding with the staffing company's outstanding sales pipeline and upcoming work commitments. It provides payroll support when taking on new temporary assignments without requiring the firm to outlay significant funds up front. For staffing agencies with strong client relationships and contracts, it delivers flexible working capital. Pros. Access capital needed for temporary ramp-ups. Pay employees as they complete work. Cons. Need strong sales pipeline to secure financing. Loans can be capped based on order sizes. Asset-based loans, ABL. Asset-based loans provide revolving lines of credit using a staffing firm's accounts receivable as collateral. Interest rates are lower than factoring invoices, but asset-based lending eligibility requirements eliminate many newer and smaller agencies. With asset-based loans, the lender advances a percentage of the staffing company's outstanding invoices and accounts receivable balance. As the staffing agency collects on those outstanding client invoices, they repay the loan. The repaid portion then replenishes the revolving credit line. For established staffing firms with strong receivables and low default risk clients, asset-based loans provide access to capital at lower costs than other financing methods. The loans can flex up or down based on the current receivables pool. The application process is more extensive than alternative financing but offers a longer-term and reusable line of credit. Asset-based loans allow financing payroll and growth at competitive rates. Pros: lower rates than factoring, 3.7%. Can replenish funds as invoices get paid. Cons: lending criteria eliminates many newer firms. Longer application process for approvals. Payroll funding. Some niche lenders offer payroll funding services designed specifically for the staffing industry. They understand your unique needs. Pros: specialized for staffing with flexible terms. Faster and easier than traditional loans. Ongoing payroll advances. Cons: rates higher than conventional loans. Require consistent sales and payroll history. Bottom line: balancing payroll obligations with inconsistent cash flow gives staffing agencies gray hairs. But take heart, payroll financing solutions let you pay employees on time without begging and borrowing. Put payroll problems to bed with funding that aligns to your workflow. Dream of growth instead of shortfalls by calling 888-653-0124.